All right, joining us for more on the Fed's meetings minutes is John Herrmann, Director of Rate Strategies at Mitsubishi UFJ Securities. Always good to have you on the show, John.
Great to be back.
So, John, what is your takeaway from the Fed statement? Patient, not so patient?
You know, I think this year they're saying they're patient. They're saying they've seen good growth, as we've been talking about. The unemployment rate is coming down fast. But they are also noticing that, you know, the inflation numbers, as you cited earlier, are moving away from their target. We're grinding lower on inflation, so that's a concern. And they are also adding to their concerns. They're monitoring financial market volatility and also monitoring situations in international markets.
So when would you forecast a rate increase?
I think what the market did, the way the bond market reacted today was the market actually, they lowered a little bit the expectations for mid-year. So they sort of pushed them back a little bit towards September. But what they really did is, if you looked out further, like another year or so out, they reduced the amount of cumulative rate hikes that the Fed will do. So that's called a flatter yield curve. So they flattened the yield curve.
At the same time, though, the Fed was very upbeat about the state of the real economy. They cited solid growth, strong job gains. Unemployment levels have been part of the dual mandate. At what level
do you have to go? So here's that I think is going to be the key question. And I think the upcoming March meeting from the Fed is going to be very interesting because they'll actually speak about things and they'll come up with their new growth projections and new inflation projections and their new interest rate projections. So I think that's going to be really interesting. But the key thing is, there's this concept of NAIRU. This is this unemployment rate below which the inflation normally accelerates. So they thought it was 5.3%. We're currently 5.6%, but they may start to mark that down.
Well, you know, John, we always play this game interpreting what is behind the Fed's language.
Yes.
This is the game that Wall Street and economists play. And some have taken it to interpret that they're still on track for June, maybe even September.
Right. So they haven't thrown that out yet. They are keeping that in. So the interesting thing is going to be, you know, I think as you've been highlighting over the last several days and so, that the currency move has created a little bit of disruption in corporate earnings.
Right.
And we have seen oil also disrupt some earnings performances.
Well, let's talk about that. What impact does the strengthening dollar play into a potential Fed decision to raise rates, which would strengthen the dollar further?
Well, what we're seeing overseas is the growth has weakened in Europe and also in China and Japan. So it's weakened three of the main regions of the world. And central banks around the world are reducing their interest rates. So if the U.S. starts raising rates, our currency will appreciate even further than it's already done, and it's been on a rampage for the last 6 or 7 months. So that, as we've seen just recently for fourth quarter guidance, we've seen that result in lower estimates for revenues. So that is the concern.
Okay, now you mentioned the rest of the world.
Yes.
And is the Fed able to take a move in the complete opposite direction of all other central banks? Would it reduce stimulus when we're seeing the ECB come out with a big sort of QE type of program, buying sovereign debts? We have Denmark, Canada, Switzerland, India. All of their central banks have cut short-term policy rates recently. Is it feasible that the Fed would act in complete opposition?
Exactly. So I think that's the key question. And, you know, just think about it. In the December meeting just a few weeks ago, they said that they were planning to raise rates 4 or 5 times this year in 2015. That just seems completely out of sync with the global financial markets and even what, you know, most people are telling the Fed in the bond market. So I think it's really unrealistic that they'll do that many hikes, you know, and I think the key thing to watch going forward just on this is to look at the wage pressures in America and whether or not it's feeding into core inflation. So far, it's fairly benign. And if it remains so, it means the Fed may even be on hold longer.
Well, John, how does oil play into this and the dramatic decrease in energy and oil prices and what that means for inflation or potentially deflation?
Exactly. So we have, believe it or not, for headline inflation, we think it's going to turn negative in about 2 months to 3 months, and then stay negative for about all of the second quarter into July because of this pricing effect on oil. So that's So that's going to be your headline risk. That'll most likely lead to, average wage guys demanding less wages. I mean, they're not going to demand the wage increases when oil prices are falling. So that keeps wage pressures kind of benign. So the Fed is in this mixture this year that is not like a normal year. Normally we get good growth here, we get inflation pressures, lower unemployment rate, and it's a straightforward call. This time around, it's just not that straightforward, unfortunately.
It really never is, John. It really never is that straightforward, especially when it comes to deciphering the Fed. All right, we're going to have to leave it there. Thank you very much, John Herrmann, Director of Rate Strategies at Mitsubishi UFJ Securities.